Good morning, ladies and gentlemen, or good afternoon, depending on where you are watching this video from. All right. Today we are going to be speaking in a very short video, and we are going to be talking about liquidity, the concept of liquidity. One of the most important concepts in forex trading is liquidity. There is this popular saying that goes, if you do not see the liquidity, then automatically you are the liquidity. Without understanding of liquidity, you cannot excel in trading. It's impossible, because trading is basically liquidity. Liquidity is money. A car cannot function without a fuel. It's not possible. The same way, liquidity is like the fuel of the market. Are you with me? Liquidity is like the fuel of the market. Every massive movement you see in the market is sponsored by adequate liquidity. Now, the concept of liquidity, like I say, it's something that, regardless of what pattern, what model you trade, liquidity is something that without its knowledge, you will not do properly well, you not do well. And today is going to be our first video looking deep into what liquidity really is. Like I said earlier, liquidity is what is money. It is what drives the market. It is what gives the market volume, volatility, and everything. And when we talk about liquidity, there are so many representation of liquidity in the market. A lot of them. So many representation of liquidity in the market. Some of you here must have heard of something we call what's it called? Structural liquidity. We have things like trend line liquidity. We have so many other ones like equal lows and equal highs liquidity. These are all types of liquidity which many of us know about. Today, we are going to be looking at what we call engineered liquidity. As time goes on, I'm going to be making lots of videos on liquidity, and we're going to be covering all those other types of liquidity. But today, for our first video on liquidity, we are going to be dealing on what I call, or what we call, or what you know as engineered liquidity. Now, let's do some little architectural design on the chart. Like I made mention earlier, market cannot function without liquidity. Let's say we are in an uptrend. We go like this, we have a break of structure, we have a new higher high, then we get a retracement, a pullback, we get a what? We get, probably let's see there's a POI here. We tap the POI, we have a new higher low, back up. Are you with me? Back up to have a new higher high and a break of structure here. Let's say, for example, there is a POI somewhere around here. And then our expectation is for market to do what? To come all the way back down to this particular point of interest, touch it, and go back up. Now, what you have to understand is that if the market comes all the way down to this particular point without taking adequate liquidity, it will not be able to go back up. Are you with me? Now, the only thing that gives the market enough momentum to go back up while falling is liquidity. Are you with me now? It's called what? Liquidity. A falling market will keep on falling until it has absorbed enough liquidity to go back up. The same way, a rising market will keep on rising until it has absorbed enough liquidity to go back down. That is why we have what we call the sell side liquidity, and we have what? The buy side liquidity as well. Now let's see, for this first higher high created here, probably there is something like an inducement on this particular side here on this other side, inducement around here, and then after the inducement we have a POI somewhere around here, as you can see. So what happened? Market comes all the way here, take out this inducement. The inducement is another form of liquidity, but it's created on the right side. As you can see, inducement, take it out, touch our POI, and then poof. Now, without liquidity, this move here will not happen. It's unlikely to happen. It's not likely to happen. Now, let's say on this, why the market was on the move to give us this break of structure here. As you can see, let's say an inducement was not created on this particular side. Inducement was not created on this structure. And market went all the way here and started coming down again. It began to return again, approaching our POI. Now, if market comes down to our POI without inducement, without nothing, and touch our POI, there is a high tendency of this particular POI failing. And in that case, this low here is going to be taken out as liquidity. Then what? A POI here will be used for the market to go back up. Now, in a case like this particular low that has been used is what we call a structural liquidity. It was a full structure here. Of course, we have a break of structure here. The market came all the way down here and then went back up, broke structure again. And it was meant to be protected. You get that kind of thing? It was meant to be protected. But all of a sudden, the market came all the way down here. Now, the law of structure is that at least after a break of structure, a certain low, the low before the break of structure should be protected. But in a case whereby there was not enough liquidity to be taken by the market while approaching a POI on that particular structure, there is a high tendency of the low of that lower and higher low to get taken as liquidity. Now, come with me again. Why this structure was being built from here to here, there was no liquidity found on it. And for that reason, market came on the way down here and do what? And take here out as liquidity. Now, there are other kind of cases whereby without inducement being created here, there is another kind of liquidity that can be created on its own here just before touching our POI. Now, that particular kind of liquidity is what we call an engineered liquidity. What is an engineered liquidity? Engineered liquidity is a type of liquidity that has been engineered right before our POI. Right before our POI. To give us a chance or to validate our entry. Look at this structure. There is no inducement. And market begin to come down. Let's say it comes all the way here. Very, very close to our POI. And then all of a sudden changes direction and begin to go up. And a lot of traders will be like, I may not wait anymore. Of course, here is my POI, but it seems like the market may not come back or come down to my POI anymore, since I'm having a sharp movement to the upside. And because of that, many traders will do what we call fear of missing out, FOMO, and they will join the buy from this particular point. Probably they will enter the buy here, and then they'll keep their stop loss here, protecting here. And all of a sudden, after the market has made some movement to the upside, approaching this particular area, and then you see, boom, market returns back to the POI, clearing everybody that set their stop loss around here, and then touch our POI, then boof, we are back up. You see this? So since liquidity was not created on this particular area, since liquidity was not created on this particular structure, Another form of liquidity was engineered to deceive traders into buying too early. Now, why so many traders have entered into the buy? All of a sudden, they bring price down, reaching our POI that many people thought price was not going to reach. And what happened? Their stop loss has been what? Triggered, because most of them are protecting this low here. They enter somewhere around here, expecting this particular high to get taken, and they keep their stop loss here. And what happened? Gone. Price returns back to our POI, and then go back up. So what is engineered liquidity? Engineered liquidity is that slight manipulation done by the market makers right before our POI, just to manipulate impatient traders into buying or sell before their POI, in form of what? FOMO. You see this now? So price was very close to the POI, but price did not touch the POI and started going up. And for traders that are not patient enough, they jumped into the move with the motion that price may no longer come down to their POI. And what happened? At the end of the day, price come down, sweep every of their stop loss as liquidity, giving market enough momentum to finally fuel the upward movement. That is why I said earlier that there is no move in the market without liquidity. One of my new principles of trading currently is that once I do not see an engineered liquidity in a particular trade, in a particular setup, I'm not entering. Because engineered liquidity gives me that level of confidence. It gives me confidence. It gives me a lot of crazy confidence. A lot of crazy confidence. Now, I draw something again. Let's say here is my POI. My POI. And then market was up. Maybe somewhere around here. Went all the way up. I expect market to touch here and go up. Now, am I going to expect market to just, price to just touch that particular POI and go up? No. I expect a manipulation. I expect manipulation. What is that manipulation? Price comes very close to my POI, begin to go up. By this time, a lot of impatient traders, they jumped on the trend. Oh, the trend has what? Changed. The pullback is over. We're about to go up. Let's jump in. They jump in and they begin to move. Why? I stand on business. My POI is here. And then all of a sudden, price comes back down again. Clear every one of them. Touch my POI. And then what? We get this. So this particular thing here, you see, this manipulation here, you see, is what we call engineered liquidity. Engineered liquidity. I'm going to show us a chart example quickly, and we are going to end this video because my intention is to make this video a very, very short one, so that it's not going to take much of our time. So let's check GBP USD for examples. Let's see if we can see something quickly. GBP USD. Let me use forex.com. Okay, GBP USD. Let's look for something. Okay. All right, let's do something here. Okay. All right, this looks good. Okay. We have a break here. Something that signifies, oh, we're expecting an uptrend. Have a break. And then aside from the break, we have price went all the way down here, begin to come down. Now on 1 hour, let's check 1 hour. On 1 hour, we have another block here as visible here. We have another block here, very, very visible. And as you can see very, very well, price went all the way here and started coming down. Came down, started coming down, come down all the way here to the other block. And then what happened? Went up slightly and then good. The reason why this particular market could not go up to break structures, because if you look at here very, very well, you will come to understand that there is nothing like a tangible liquidity on this side. There is no tangible liquidity on a particular side. Are you with me? Now let's check 30 minutes. Let's check 30 minutes. As you can see, because of that, that other block was somewhere around here, but there was no tangible liquidity on this particular side here of the market. So we are expecting the market to engineer a liquidity. So for example, if an engineered liquidity was provided somewhere around here, this is too far. If an engineered liquidity was provided somewhere around here, I could have taken a POI here. But look, a single candlestick all the way from here and here entered this particular area, my POI area. No engineered liquidity was provided. So because there was no engineered liquidity provided for this POI, it means this POI is invalid for me. I won't take it. So I'm going to be looking at my next POI. And where's my next POI? My next POI is an FVG present here. As you can see an FVG present here. And let's say price came very, very close to the FVG, as you can see. Let's say from here, very close to the FVG, did not touch the FVG, started going up. On its way up, a lot of traders jumped into it. Oh, the market may not come down to this FVG anymore. Let's just jump into it. A lot of traders may jump into this particular trend, wanting to buy to take out this high and probably take out this high also. Are you with me? And all of a sudden, market came all the way here and then whoosh, took everybody out. Took everybody out. And from there, we can say, okay, good. Back up. Good. Now, before you get a break of structure, before you have a new break of structure, there has to be a tangible amount of liquidity. The liquidity present here is not enough to give us a break of structure. That's the reason why it's more like when you throw a ball to the air with a little force. Market went all the way here, but it's not enough. Came back down. Are you with me? Came back down because there's not enough momentum. The liquidity is not enough. And then came back down, clear everybody here. So automatically, this particular zone here, so let me mark it out here. As you can see, was used as what? Engineered liquidity for this POI. I see it now. Market came very close to it, but it didn't touch it. Went up, came all the way down, touched our FVG, and then boom. So if I was to enter this market, I'm gonna go this. I will enter just at the edge of it, of the FVG. I'll keep my stop loss slightly below this particular low here, this strong low, and then I'm looking for 3RR. So I take it up. I'll be targeting this particular high here. Let's see if I can get 3RR. Okay, not complete, but there's another one here. As you can see, this particular one here. Okay, not up to it, but I get my 3R, and can you see? Poof, and that is it. If I entered here, let's say I wanted to FOMO, I enter here, keep my SL here, I would have taken an SL in this trade. So this is what engineered liquidity, a type of liquidity that is engineered just before the main POI. You see that now? So that's it. I think there is another example again of engineer liquidity here that I can show to us before I end this video. Okay, let's see, we are on 1 hour time frame. 1 hour time frame. Okay. Let's say, okay, that's good. We have something here. Something here. Market came all the way from here. Okay, let me draw it quickly. We have something from here, and then we have this. We have also this, and then this, and of course back up, as you can see. But this particular move wasn't as smooth as I'm drawing it on the chart. Something happened, and I'm going to explain that to all of us here right now. So what happened is that, let's say on 1 hour time frame, we have a POI somewhere around here. As you can see, this is a support key level. As you can see, support key level right there. And then of course I'm going to use that. It's a key level, a support key level right there. And then market was dropping, price was, pullback was happening, and the intention was to, of course, touch our key level and go back up. And if you see very very well on this particular structure, there's no liquidity anywhere, no single liquidity. So in a case whereby there's no liquidity on the structure side, you wait for what? An engineered liquidity. So what happened? Market came very very close, all the way from here, very very close to our POI, which is my support key level. And then what happened? Very close to it, and then started going up. Started going up here. As you can see, it's very very obvious. Started going up. If I put this particular thing, let's say on 15 minutes, you can see that move to the upside was kind of significant. It's significant. It moved all the way from here to here. On this particular side, many traders will be waiting for a pullback to this particular side and buy, thinking that, oh, price may not come down to our what POI anymore. As you can see, on 15 minutes here also can be used as an FVG. For those of you that do not understand the 1 hour key level that I use, use an FVG here, FVG below here. Are you with me? An FVG below is particular engineered liquidity here. It's an FVG clearly here. Now, price did not come down to the FVG and started going up. And a lot of people will be like, oh, price may no longer return to the what? To the FVG. To the FVG. So because of that, let me mark the FVG out for those of you that will not see it clearly. It's an FVG here. It's a clear FVG. Okay. It's slightly touching the candle of that. Okay. Okay, good. It didn't touch it. Okay, so I just want to be sure you didn't touch it. How do I draw it now? Okay, good. As you can see, this particular guy here is on the same line. This engineer liquidity is on the same line with this particular little inducement over here. It didn't cross it. It's on the same line. It's equal line, and there's an FVG below it. You see, but I wasn't using the FVG actually. I'm using the key level, which is here on 1 hour time frame. This particular support key level here, and price came very close to the support key level, and before touching the key level, it started going back up, and deceived a lot of traders thinking that, oh, price may not come to our key level anymore. For key level anymore. For that reason, let us jump into the word they buy, and they buy, of course, and they keep their stop loss below this manipulation. And all of a sudden, price came back, sweep the particular place, touch the key level, and then boom, up. So if I was to enter this trade, I enter right on the key level, which is here. here, and then my stop loss is going to be below this candle here, as you can see. Yeah, and then I'm going to target this particular high here. This high. This is already too much. Normally I go with 3 hour. 3 hour is going to be something around here, but for those of you that like to target, the high, you target high and you get this already, you get 4 point something an hour. So this is basically what engineered liquidity. For the last time, for those of you having difficulty, is this. You have this market all the way up to this particular side. There is no liquidity provided here, and our POI, let's say we have a POI somewhere around here, market is meant to come down, touch the POI, and then do what? And then bounce back up. So without liquidity here, it will get broken. So for here to not get broken, a liquidity will have to be engineered. So what do we expect? We expect market to come all the way down here, not straight. If it comes straight to it, it will break it. It will get invalidated. It will take out this low. Are you with me? So market came very close to our POI, and without touching our POI, it begins to go up, deceiving traders to jump in, thinking that, oh, the market may no longer return to what? To our POI here, and the jump in, so somewhere around here, maybe probably there will be a little pullback here, and they'll be like, oh, let's enter the pullback somewhere around here, and they'll keep their stop loss here, not knowing that market will come down, clear them, touch its intended POI, and then boom, go back up. So we call this manipulation here an engineered liquidity this year, and what? An engineered liquidity. So thank you, ladies and gentlemen. Please, if you are watching this particular video, if you watched it and if you learned anything, give me a follow and turn on notification. More videos on liquidities will be dropping. Bye.